this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me today. I'm speaking with Ike Iossif, who runs the website MarketViews.tv. How you doing today, Ike?
I'm doing good, Mike. How about yourself?
Oh, I'm doing great. And I know we did an interview a month or two ago about the financial markets and what your indicators are showing. This presentation that you put together today is very important. In fact, it may be the most important thing happening, period, when it comes to the financial markets this year. So I'm very glad to be able to talk with you about this.
We are going to have the second part of this interview later in the week, I believe Friday. And the thing is, we did not want to overwhelm people talking, 45 minutes, 60 minutes. I think it would be better if we break it up in two parts and we highlight what I believe is important, people need to pay attention to. And then when we do part two later in the week, we will discuss all these issues in detail.
Well, the big issue in today's discussion is going to be the bond market. And something really unusual is happening with the bond market and the stock market, because historically bonds go up when interest rates are declining, and they are looking forward to the Federal Reserve lowering rates or recession happening, and typically that's bad for the stock market. However, so far, since December, both bonds and the stock market have been going up really tremendously. I mean, the move has been fairly, sizable in a short amount of time, especially in the first 2 months of the year. So can both these markets continue to do this, or is one of them wrong, do you believe?
Well, let's backtrack for a second. We did an interview on January 15th in 2018, right at the beginning of the year. And at that time, I emphasized that the bond market was going to determine how things would go for the stock market in 2018. As it turned out, at the end of the year, we had a 20% decline in the major indices, and all had to do with the way the bond market behaved. And then, since the beginning of the year, we have had a tremendous rally in the equity markets because supposedly the Fed is on pause and there will be no more interest rate increases. We did another interview on January 31st of this year, and again we highlighted that this year, in my view, the bond market also was going to determine how the stock market behaves. Now, both these interviews, the one from January 15th of 2018 and the one from January 31st of 2019, they're both posted in your YouTube channel so people can look it up and watch them. Over the last 4 months, we have had a 23% rally in equities and a 30% decline in the yield of the 10-year Treasury bond. And we can see this, in the chart. This is from the analysis that I had from my subscribers a couple of weeks ago. Now, the magnitude of both moves is extraordinary, given the short period of time in which they took place. However, I believe the real issues investors need to be concerned with are these. A, is the 30% decline in the yield of the 10-year T-bond just the beginning of a multi-month bigger decline due to an economic slowdown, or even due to an upcoming recession? Some expect a recession at the end of 2019 or early 2020. B, history has shown that declining rates due to a recession have never prevented the equity market from experiencing 30 to 50% losses. So if we're going to have a meaningful economic slowdown or even a recession, how come the S&P is up 23%? And the third issue, the third question people need to ask is this: if the fear of a recession are overblown and the rally in equities is the beginning of a new leg to the upside in the 10-year bull market, then bonds, or bond investors I should say, are in for a surprise. And last but not least, if the fear of a recession are not overblown, then equity investors are in for a surprise later in the year. In no likelihood, one of these two extraordinary moves of the last 4 months will be proven wrong in the next 6 months. And either bond investors or equity investors, I believe, will pay the price for the miscalculation. Moreover, in the last two interviews that we did, I showed many times that every time the yield on the 10-year bond got up to its declining top line, the equity market went down. So if we're going to have a rebound in the second half, then more than likely bond yield in the 10-year bond will go above 3.25%. That in itself will be proven problematic for the equity markets.
Well, that kind of situation would almost feel like a repeat possibly of what happened last fall when the Fed spoke about getting more aggressive on interest rates. We tapped that level and the market fell 20%.
If you look at the GDP rate of growth, we can see clearly that since July of 2018, GDP has decelerated. But that does not mean necessarily that we're going to have a recession. Because if you look at the next chart, we can see that we had similar slowdowns 2010, 2011, and again between 2015 2016. The economy rebounded and the market went up. So right now, we can see the economy is decelerating, but it doesn't necessarily mean we're going to have a recession. Furthermore, the last 30 years between bonds and equities, we can see, and that is our third chart, something really interesting. First of all, it's obvious, and I have spoken about this many times before, that every time the yield on the 10-year bond has gone up to its declining top line, we have had a major decline in the stock market. What is interesting in this chart is this. The 22-month moving average is an indication of the long-term trend. Now, we can see that in 2000 and again in 2007, the yield on the 10-year bond went below its 22-month moving average, as so did the stock market. If you look at what happened in 2015, 2016, we can see that the bond yield went below its 22-month moving average, but the stock market, when it's below 22-month moving average, only a couple of times briefly, and then it went right back up again. Exactly.
Yeah.
And this is what we're seeing right now again. We can see that the yield is below its 22-month moving average, but the S&P is above. So right here, we're having a dichotomy. And I believe one of the two will happen. Either the market will turn back down again, or what we're going to see is a resumption of the uptrend in yield.
Well, a lot of people, most people in the United States who are invested in the stock market typically have a portion of their money in stock market funds and then a portion of their money in bond funds. And most people, frankly, aren't very worried about the stock market or maybe even very bullish. We've come back. We had a dip like we saw last fall in 2015, and the market recovered and went up for 2 years. So I think there's a big expectation of more gains. But even if people feel that way, I do think they need to watch out for what could happen with the bond market, because if they're right on their stock market beliefs, then what you're showing us is that things are going to change when it comes to the bond market, so their bond investments might take a hit before the year's over.
Yeah, exactly.
In the interview we did on January the 15th, you identified the 2875 to 2905 level on the S&P 500 as a key resistance point. We peaked at 2870, but then in our next interview, you elaborated on your reasons behind that target, and we've obviously gone above 2905. So what is your next important resistance zone as of now?
Well, the interview you were referring to, Mike, was on January 15th of 2018. And we had spoken about the different support and resistance target zones. And I had said at the time that the 2875, 2905 zone was going to be the first real important resistance. People can listen to this interview. It's also available in your YouTube channel. The market on January 29th topped at 2870. Then later on in the year, on May 4th of 2018, I went back and I elaborated why I had identified that target zone as very important. And that had to do with the inflows, outflows analysis that we do. Now, people who listen to us over the years know that this is a very important indicator. It's proprietary, and we talk about this about twice a year. The chart is a indicator of the 10-day moving average cash inflows, outflows for the 40 most active stocks on a daily basis from the OEX and the NDX combined. These are the 40 stocks that move the market around. And I had pointed out that when we had done the interview on January 15th, we had a divergence going back to December of the previous year. I had hypothesized that at the rate things were going, within a couple of weeks, or by the time the market got up 28.75, we would have a negative crossover. And that is exactly what happened. We had a negative crossover, and we had a big decline starting on January 29th of 2018. The question is, what is this indicator telling us now? Well, we're going to discuss this in part 2. But I will say this. On March 3rd, I sent out the monthly analysis to our subscribers. And at the time, I had given them 2 different scenarios. You can see scenario 1 on the left, and we can see the actual price movement on the right. It looks like this scenario is playing out. The inflows, outflows indicator is giving us a target, which I said I'm going to discuss in great detail in part 2 of this interview. I think is going to be very interesting for people to see what would mean if the market taps out at this new target we have, or it exceeds it.
Well, when it comes to that question, are charts the entire puzzle to answering it, or just part of it?
Well, I'm glad you asked this question, because this is something that people really need to pay attention to. I have made the next 2 charts up myself for the purpose of illustration. The chart that we're looking at right now, we'll call it XYZ 100 index. And let's say it represents the 100 biggest stocks in a major, mature, semi-efficient market like ours. We can see that at point A, the chart shows an inverted head and shoulders. Okay, so the market breaks out, moves up to the next level. At point B, once again, we have an inverted head and shoulders. The right shoulder is kind of truncated. Nevertheless, the market breaks out to the upside, and we get to point C. If you just look at the chart, it's very easy to say, oh my God, another inverted head and shoulders formation. I'm going to buy this because we're going to have another breakout. Let's look at the next chart. Let's say, and I want people to consider this, at point A, when we got the first breakout, the GDP was rising, the unemployment rate was falling, and the inflation was stable. At point B, once again, GDP was rising, the unemployment rate was falling, and the inflation was stable. But as we come to point C, and again, I'm making this up just for the purpose of illustration, this is not a reflection of the economy, of the US economy. This time around, the third time, GDP was flat. The unemployment rate was rising, and the inflation was rising. Would it make sense to expect a break on the upside? Probably not. My point is this. The chart alone does not tell the whole truth. The chart alone is not the puzzle. It's a piece to the puzzle. It's not all of it.
Let me ask you this about that. In the last 2 bear markets, I would say we saw GDP flatter down, unemployment rising, but inflation falling. You know, especially in 2002, 7, 8, there was a whiff of deflation, really. And the bear market before that, I don't really think there was high inflation at all. In fact, the Fed was afraid of deflation. That's what Alan Greenspan talked about. What would happen? So that's the environment we're used to, I think, as market participants. But what would happen if the GDP was down, unemployment was rising, and inflation was rising instead of falling? What would that do to the bond market?
I think what would make bigger difference is the rate that the inflation was rising. I mean, there's a difference between going from a 2% inflation per year to 2.5 and going from 2 to 3.5. I think the rate of the rise in inflation would make the biggest difference. But what I want people to get out of these two charts that I said I made them up for the purpose of illustration is that you cannot look at a chart alone out of context. You need to put the chart in context. And next time when we do part 2 of this interview, what we're going to do is put the charts in context.
Yeah, we'll have that out by the end of the week. And if you're just randomly watching us on YouTube, subscribe to the YouTube channel to make sure that you get part 2. We'll talk with you then. And thank you, Ike, for taking the time to talk with me and everyone else.
My pleasure. I'm looking forward to part 2 where we'll discuss all the details.